The Psychology of Money Complete Book Summary. 20 Timeless Lessons That Will Change How You Think About Wealth. Have you ever wondered why some people earn millions yet end up broke, while others with average incomes quietly build lasting wealth? Why do intelligent investors make terrible financial decisions? And why does money seem to bring peace to some people but endless stress to others? The answer, according to Morgan Housel in The Psychology of Money, isn't that money is simply about numbers. It's about behavior. Your financial success depends less on how much you know and more on how you think, how you react, and the habits you build over time. In this complete chapter-by-chapter summary, we'll explore 20 timeless lessons that can completely change the way you think about wealth. These aren't complicated investment strategies or get-rich-quick tricks. Instead, they're powerful insights into why people make the financial decisions they do and how you can make better ones. Whether you're just beginning your financial journey or already investing, these lessons can help you build not just more money, but a healthier relationship with it. Let's begin with the first lesson. Chapter 1. No one's crazy. Imagine two people sitting across from each other discussing money. One believes the safest place for their savings is a bank account. The other invests every spare dollar into the stock market. One spends freely on experiences, believing life is short. The other saves obsessively, preparing for an uncertain future. Who's right? Most of us instinctively assume one person is making a mistake. But Morgan Housel argues that neither is necessarily wrong. His first lesson is simple yet profound. People don't make financial decisions based purely on facts. They make them based on their own experiences. Every financial decision you make is shaped by your personal history, where you grew up, the economy you experienced, your family's beliefs about money, and even the generation you were born into. Someone who lived through a financial crisis may fear investing for the rest of their life. Someone who watched their parents build wealth through real estate might believe property is always the safest investment. Neither person has experienced every possible economic condition. They've only experienced their version of reality. And that's where misunderstandings begin. The power of personal experience. Think about someone who graduated during a recession. Finding a job was difficult. Businesses were closing. Money was scarce. That experience can permanently shape how they think about spending, saving, and investing. Now compare that to someone who entered the workforce during a booming economy. Jobs were plentiful. Salaries were rising. Investments seemed to grow effortlessly. Both people may look at the exact same investment opportunity and come to completely different conclusions, not because one is smarter, because their experiences taught them different lessons. Why financial advice often fails. This also explains why financial advice doesn't always work. A strategy that transformed one person's life might fail completely for someone else. Advice often assumes everyone shares the same background, fears, goals, and opportunities. But they don't. Imagine telling someone who grew up in poverty to take more financial risks. To them, losing money isn't just disappointing. It feels dangerous. Now imagine telling a wealthy entrepreneur to play it safe. To them, avoiding risk may feel like missing opportunities. Neither perspective is irrational when viewed through the lens of personal experience. The story of Ronald Reed. Morgan Housel shares a remarkable story of Ronald Reed. Reed worked as a gas station attendant and later as a janitor in Vermont. He never earned a high salary. He drove used cars, lived modestly, and rarely attracted attention. When he passed away in 2014, many people assumed he'd left behind a modest estate. Instead, he had accumulated around $8 million through decades of disciplined saving and patient investing. His story surprised the world because people often assume wealth comes from extraordinary income. But Ronald Reed proved something different. Extraordinary behavior can matter more than extraordinary earnings. What this means for you. The lesson isn't that you should copy Ronald Reed exactly. The lesson is that you should stop judging financial decisions only through your own experiences. When someone makes a money decision you don't understand, ask yourself, what experiences might have led them to think this way? More importantly, ask the same question about yourself. Which of your beliefs about money come from evidence, and which simply come from your personal history. Recognizing this can help you make more thoughtful decisions instead of automatically repeating habits you inherited. Key takeaway. No one is completely objective when it comes to money. Your financial decisions are influenced by the experiences you've lived, not just the information you've learned. The wiser you become, the more you recognize that your perspective is only one of many. Understanding that is the first step toward making better financial choices. Chapter 2, Luck and Risk. Imagine two entrepreneurs. Both are intelligent. Both work incredibly hard. Both launch businesses in the same industry. One becomes a billionaire. The other goes bankrupt. Was one simply smarter? Not necessarily. Morgan Housel reminds us that luck and risk play a much larger role in our lives than we often admit. We love stories that explain success as a direct result of talent and effort. And while those things certainly matter, they don't explain everything. Life is more unpredictable than we'd like to believe. Bill Gates and a rare opportunity. Housel points to a fascinating example. Bill Gates is unquestionably brilliant. He worked tirelessly and built one of the world's most influential companies. But there was another factor. Gates attended one of the very few schools in the United States that had access to a computer terminal during the late 1960s, a time when such access was extremely rare. That opportunity allowed him to practice programming thousands of hours before most students even touched a computer. Without that unique circumstance, his path might have looked very different. This doesn't diminish his achievement. It simply reminds us that extraordinary success often involves extraordinary opportunities. Luck doesn't mean success is accidental. Acknowledging luck doesn't mean effort is meaningless. Bill Gates still had to work relentlessly. He still had to make excellent decisions. Luck opened a door. His preparation allowed him to walk through it. The same is true for many successful people. Opportunity creates possibilities. Behavior determines what happens next. Risk is the other side of luck. Just as luck can elevate someone unexpectedly, risk can derail even the most capable person. Think of an investor who carefully researches every decision. Then an unexpected global crisis causes markets to crash. Was the investor suddenly foolish? No. Some events simply cannot be predicted or controlled. This is why humility is so important in finance. Success isn't always proof that every decision was perfect. Failure isn't always proof that every decision was wrong. Don't idolize every success story. One of the biggest mistakes people make is copying successful individuals without considering the role of luck. A business founder might describe the exact steps they followed to become wealthy. Readers often assume repeating those steps guarantees similar results. But countless people may have followed nearly identical paths without achieving the same outcome. The difference wasn't always intelligence or discipline. Sometimes it was timing. Sometimes it was location. Sometimes it was meeting the right person at the right moment. And sometimes it was simply chance. Focus on what you can control. If luck and risk exist, does that mean nothing matters? Quite the opposite. It means we should spend less time trying to predict the unpredictable and more time strengthening what we can control. We can control how consistently we save, how wisely we invest, how much debt we take on, how patiently we think, how prepared we are when opportunities appear. These behaviors don't eliminate luck or risk, but they make us more resilient when life surprises us. A powerful mindset shift. One of the healthiest financial attitudes is accepting uncertainty. Instead of believing every outcome reflects personal brilliance or failure, recognize that the world is more complex. Celebrate success with gratitude rather than arrogance. Respond to setbacks with resilience rather than self-condemnation. That mindset not only improves your financial decisions, it also brings peace of mind. Key takeaway: hard work and good decisions are essential, but luck and risk shape outcomes more than most people realize. Respect both. Stay humble during success. Stay hopeful during setbacks. And focus your energy on the choices you can actually control. Chapter 3. Never Enough. Imagine you spent years working toward your dream. You land a high-paying job. You buy the beautiful house. You finally drive the luxury car you've always wanted. Your investments are growing, and your bank account is healthier than ever before. For a moment, you feel satisfied. But then something happens. A colleague buys an even bigger house. A friend posts pictures from an extravagant vacation. Someone your age becomes a millionaire. Suddenly, What once felt like success no longer seems enough. This is a dangerous trap Morgan Housel calls never enough. It's one of the most destructive forces in personal finance. Not because people don't earn enough, but because they never feel like they have enough. The endless chase. Human beings naturally compare themselves to others. It's how we've measured status for thousands of years. The problem is that in today's world, we're constantly exposed to people who appear wealthier, happier, and more successful than we are. Social media amplifies this feeling. Every scroll reveals someone buying a new home, launching a successful business, or celebrating another milestone. We rarely see the depth behind the lifestyle, the stress behind the success, or the years of struggle behind achievement. Instead, we compare our everyday reality to someone else's highlight reel. And that comparison quietly whispers, "You need more." The tragedy is that more has no finish line. The story of Rajat Gupta. Morgan Housel tells the story of Rajat Gupta. Gupta was one of the most respected business leaders in the world. He rose from humble beginnings to become the managing director of one of the most prestigious consulting firms on the planet. He served on the boards of major corporations, advised world leaders, and earned millions of dollars. By almost any standard, he had already won, yet that wasn't enough. Driven by the desire for even greater wealth and status, Gupta became involved in insider trading. The consequences were devastating. He was convicted, sentenced to prison, and lost much of the reputation he had spent decades building. The lesson isn't simply about crime. It's about the inability to recognize when you've already achieved enough. When more becomes your only goal, you're far more likely to take risks that aren't worth taking. Knowing when to stop. One of the hardest financial skills isn't earning money. It's knowing when to stop chasing it. Imagine playing a game where every round offers a chance to double your wealth. Sounds exciting, right? But every round also carries a possibility of losing everything. How long would you keep playing? Many people answer, just one more round. That's exactly how greed works. Instead of protecting what we built, we gamble it in pursuit of something we don't actually need. History is filled with wealthy individuals who lost fortunes because they couldn't resist taking one more unnecessary risk. The irony is heartbreaking. They weren't trying to escape poverty. They were trying to satisfy an appetite that could never be satisfied. The price of comparison. Comparison is especially dangerous because the target keeps moving. When you earn $50,000, you compare yourself to someone making $100,000. When you reach $100,000, you compare yourself to someone making $500,000. When you become a millionaire, you notice billionaires. There will always be someone with more. If your happiness depends on being richer than others, you'll spend your entire life feeling behind. Instead of measuring your life against someone else's wealth, measure against your own goals. Ask yourself, can I pay my bills comfortably? Am I providing for my family? Am I building financial security? Do I have the freedom to live the life I want? Those questions matter far more than trying to impress strangers. Protecting what matters most. The pursuit of more can cost far more than money. It can cost your relationships, your health, your reputation, your peace of mind. Imagine sacrificing evenings with your children because you're chasing another promotion you don't actually need, or risking your integrity for a bonus that won't change your life. At some point, the things you trade away become more valuable than the money you're earning. True wealth isn't about accumulating endlessly. It's about knowing what is enough for you. Actionable lesson. Take a moment and define your personal version of enough. Not society's definition. Not your neighbor's. Yours. How much income allows you to live comfortably? How much savings gives you peace of mind? What lifestyle genuinely makes you happy? Once you know your answer, you'll be far less vulnerable to the endless pressure of comparison. Because someone who knows what enough looks like is incredibly difficult to manipulate. Memorable quote. The hardest financial skill is getting the goalpost to stop moving. That single sentence captures one of the greatest truths about money. Contentment isn't the enemy of ambition. It's the protection that keeps ambition from turning into self-destruction. Chapter 4. Confounding Compounding. Imagine placing a single grain of rice on the first square of a chessboard. On the second square, you place 2 grains. On the third, 4. then 8, then 16. Each square doubles the amount from the one before it. At first, the numbers seem insignificant, but by the time you reach the final square, the number of grains becomes almost impossible to comprehend, far exceeding anything most people would expect. This is the astonishing power of compounding, and according to Morgan Housel, is one of the most misunderstood forces in finance. Why we underestimate compounding. Our brains are naturally wired to think in straight lines. If you save $1,000 this year, you might expect another $1,000 next year. Linear thinking feels intuitive. Compounding doesn't. Compounding starts slowly, painfully slowly. In the beginning, progress feels almost invisible. That's why so many people give up too early. They mistake slow growth for no growth. But compounding isn't impressive at the beginning. It's impressive because it refuses to stop. Small gains build upon previous gains. Then those gains begin generating gains of their own. Eventually, growth accelerates in ways that seem almost magical. Warren Buffett's extraordinary fortune. Perhaps no one demonstrates compounding better than Warren Buffett. Many people assume Buffett became wealthy simply because he earned extraordinary investment returns. While his returns have indeed been remarkable, that's only part of the story. The bigger reason is time. Buffett began investing as a child. He continued investing for decade after decade after decade. Most of his enormous fortune wasn't created in his 20s or 30s. It accumulated because he allowed his investments to compound over an exceptionally long period. Had Buffett started investing much later in life, even with the same skill, his net worth would likely have been dramatically smaller. His greatest advantage wasn't just intelligence. It was patience. Small decisions become massive outcomes. Compounding isn't limited to investing. It shapes nearly every area of life. Reading 10 pages every day may seem insignificant. Over a year, that's more than a dozen books. Exercising for 30 minutes each day doesn't transform your body overnight. But over 5 years, it changes your health dramatically. Saving a small amount each month may feel unimportant today. Over decades, it can create financial independence. Likewise, negative habits compound too. A small daily expense that feels harmless can quietly consume thousands of dollars over time. Ignoring your health today can become serious illness years later. Tiny actions repeated consistently create extraordinary results, for better or worse. The patience most people lack. One reason people struggle with investing is that they expect immediate rewards. If the market declines for a year or two, many panic. If their savings don't grow quickly enough, they become discouraged. They abandon strategies that would have succeeded if given enough time. Imagine planting an oak tree. You wouldn't dig it up every month to check whether it's growing. You understand that growth happens slowly beneath the surface before becoming visible. Money works the same way. The early years often require the greatest patience. The rewards come later. Time is more valuable than timing. Many investors spend enormous energy trying to predict exactly when markets will rise or fall. Morgan Housel argues that there's a more reliable strategy. Instead of obsessing over perfect timing, stay invested. Allow time to do the heavy lifting. History consistently shows that patient investors often outperform those who constantly jump in and out of the market attempting to chase short-term gains. Compounding rewards consistency far more than brilliance. Actionable lesson. Ask yourself one simple question. What small financial habit can I repeat consistently for the next 10 years? It might be investing a fixed amount every month, automatically saving part of every paycheck, reading about personal finance for 20 minutes each week, avoiding unnecessary debt. None of these actions feel dramatic today, but over decades, they can completely transform your financial future. Memorable quote, "Good investing isn't necessarily about earning the highest returns. It's about earning pretty good returns that you can stick with for the longest time." That idea challenges a common belief that success comes from finding the perfect investment. In reality, lasting wealth often belongs to those who remain patient, while everyone else is searching for shortcuts. Chapter 5. Getting Wealthy versus Staying Wealthy. Imagine two people. The first builds a company that suddenly becomes successful. Within a few years, they're earning millions of dollars. The second has never been on the cover of a magazine. They've never made headlines. But for decades, they've quietly grown their savings, lived below their means, and protected what they built. Now ask yourself this question: which one is truly wealthy? Most people assume the first person is. Morgan Housel argues that they're answering the wrong question. There's a huge difference between getting wealthy and staying wealthy. Getting wealthy often requires optimism, ambition, risk-taking, and confidence. Staying wealthy requires almost the opposite. It demands humility, patience, discipline, and an understanding that what you've built can disappear much faster than it was created. The difference most people miss. Building wealth usually gets all the attention. We celebrate entrepreneurs who become billionaires overnight. We admire investors who make spectacular returns. We hear stories of people who turn a small investment into a fortune, but we rarely hear about the thousands of people who made fortunes and then lost them. Why? Because losing wealth isn't nearly as exciting as creating it. Yet in real life, protecting wealth is often much harder than earning it. Making money is an event. Keeping money is a lifelong habit. The hidden enemy, overconfidence. Success has a dangerous side effect. It can convince us that we're smarter than we really are. Imagine an investor who earns huge profits during a booming market. Instead of recognizing that favorable market conditions helped, they begin believing every success is a result of their own brilliance. Confidence slowly turns into overconfidence. Then comes the next investment. They borrow more money, take bigger risks, ignore warning signs, because they assume they've mastered the game. But markets don't reward arrogance forever. Eventually, conditions change, and what looked like genius during good times can quickly become disaster during difficult times. Survival is the real goal. Morgan Housel emphasizes a powerful idea. If you want long-term success, your first objective isn't maximizing returns. It's surviving. Think about nature. The tallest tree in the forest didn't become tall overnight. It survived countless storms. It endured droughts. It adapted to changing seasons. Its greatest achievement wasn't growing quickly. It was continuing to grow year after year. Money works the same way. You don't need to hit home runs every year. You simply need to avoid the mistakes that knock you out of the game. The story of Jesse Livermore. One of history's most famous traders was Jesse Livermore. Livermore made and lost enormous fortunes multiple times. At one point, he became one of the richest men in America. His trading skills were extraordinary. Yet despite repeatedly earning incredible wealth, he struggled to keep it. Aggressive risk-taking, leverage, and overconfidence eventually caught up with him. His life serves as a reminder that making money doesn't automatically teach you how to preserve it. Those are two different skills. Wealth needs margin for error. Imagine driving across the country with just enough fuel to reach your destination. No extra fuel, no allowance for traffic, no detours, no unexpected road closures. Even a minor delay could leave you stranded. Financial life works the same way. People who spend every dollar they earn leave themselves vulnerable. One job loss, one medical emergency, one economic downturn, and suddenly everything changes. The people who stay wealthy usually build margins into their lives. They save more than they think they'll need. They avoid excessive debt. They prepare for problems before problems appear. That isn't pessimism. It's wisdom. Staying rich is quiet. Interestingly, people who remain wealthy often don't look wealthy. They don't constantly upgrade their lifestyle every time their income rises. They don't feel pressured to prove their success. Instead, they quietly allow their investments to grow while resisting the temptation to spend every increase in income, because they understand something many people don't. Every dollar you don't spend becomes an employee working for your future. The more employees you have, the greater your financial freedom becomes. Actionable lesson. Instead of asking, how can I make more money? Also ask, how can I avoid losing the money I already have? Sometimes avoiding a disastrous mistake creates more wealth than finding an extraordinary opportunity. Protecting your financial future often comes down to simple habits. Spend less than you earn. Avoid unnecessary debt. Diversify your investments. Stay patient during market swings. Never risk everything on one opportunity. These habits may not be exciting, but excitement isn't the goal. Longevity is. Memorable quote. Getting money requires taking risks. Keeping money requires humility. It's a reminder that lasting wealth isn't built by constantly chasing bigger wins. It's built by respecting how easily success can disappear. Chapter 6. Tails you win. Imagine flipping a coin. If it lands on heads, you earn $1. If it lands on tails, you earn $100. Would you keep playing? Of course. Even though you'll lose many flips, the few big wins make the game overwhelmingly profitable. This simple example illustrates one of the most important ideas in investing and in life. You don't need to be right all the time. You only need your biggest successes to outweigh your many small failures. Morgan Housel calls this principle tails you win. Why success looks bigger than it really is. When we look at highly successful people, it's tempting to assume they succeeded because everything they touch turned to gold. But that's rarely true. Most successful entrepreneurs have experienced failed businesses. Most best-selling authors have written books that sold poorly. Most great investors have made terrible investments. The difference isn't that they never failed. The difference is that one or two extraordinary successes overshadowed all the losses. The baseball analogy. Imagine a baseball player who gets a hit only 3 out of every 10 times at bat. That means they fail 70% of the time. Yet in professional baseball, a .300 batting average is considered outstanding. Failure isn't evidence of incompetence. It's part of the game. Investing works similarly. Even legendary investors are wrong frequently. What matters isn't the number of mistakes. It's the size of your victories compared to your losses. Amazon's many failures. Consider Amazon. Today, it's one of the world's largest companies. But along the way, it launched numerous products and services that failed. Some disappeared quietly. Others lost millions of dollars. Yet those failures became almost irrelevant because a few enormous successes transformed the entire company. Businesses don't need every idea to succeed. They need a handful of exceptional ideas that generate extraordinary value. The same principle applies to investing. Venture capital secret. Venture capital firms invest in dozens or even hundreds of startups. They know many will fail completely. Some may only survive. A very small number become extraordinary successes. Those few winners often generate enough returns to cover every failure and still produce massive profits. The lesson? Success doesn't require perfection. It requires positioning yourself so that when a rare opportunity appears, you're ready to benefit. Stop expecting constant wins. One reason people become discouraged is because they expect continuous success. If an investment loses money, they assume they're doing something wrong. If a business struggles, they wonder whether they should quit. But every worthwhile pursuit includes setbacks. Imagine planting 20 seeds. Not every seed becomes a healthy tree. Some never sprout. Some grow slowly. Others are damaged by storms. But if a few grow into mighty oaks, your effort was still worthwhile. Financial success follows the same pattern. Patience during the quiet years. This lesson also explains why patience matters so much. Many investments spend years producing average results. Then suddenly, they experience extraordinary growth. People who quit too early never experience the payoff. Think about someone who invested consistently for 15 years. For much of that time, progress may have seemed slow. Then a strong bull market dramatically increased the value of their portfolio. From the outside, it looked like they became wealthy quickly. In reality, their biggest gains were built on years of quiet persistence. Actionable lesson: don't judge your financial strategy by short-term outcomes. Instead, evaluate whether your overall approach gives you the opportunity to benefit from long-term winners. Ask yourself, am I investing consistently? Am I giving my investments enough time? Am I avoiding catastrophic losses? Am I staying in the game long enough for compounding and opportunity to work? If the answer is yes, occasional failures don't define your future. Memorable quote: anything that is huge, profitable, famous, or influential is a result of a tiny percentage of events accounting for the majority of outcomes. This is one of the most liberating lessons in the entire book. You don't need every decision to be perfect. You don't need every investment to succeed. You don't need every opportunity to become life-changing. You simply need to remain patient, keep learning, and stay in the game long enough for the few exceptional opportunities, the tails, to transform your results. Chapter 7. Freedom. Imagine waking up tomorrow morning with no alarm clock. Not because you're unemployed, not because you're on vacation, but because you've reached a point where you decide how to spend your time. You can work if you want to. You can rest if you need to. You can travel, learn a new skill, spend time with your family, or pursue a passion project without constantly worrying about money. For many people, this sounds like a luxury. Morgan Housel argues that it is something far more valuable. Freedom is the highest dividend money can pay. Not luxury cars, not designer clothes, not a mansion. The greatest benefit of wealth is having control over your time, the most valuable asset you own. Think about your day. How much of it is truly yours? Most people spend years trading their time for money. They wake up early, commute to work, attend meetings, answer emails, and return home exhausted. There's nothing wrong with working hard. The problem arises when you have no choice. When every decision is dictated by financial pressure, money stops being a tool and starts becoming a master. Real wealth gives you options. It allows you to say no to opportunities that don't align with your values. It gives you the ability to leave a toxic workplace. It lets you spend more time with your children while they're still young. It gives you the confidence to pursue meaningful work instead of simply chasing the highest paycheck. In other words, money buys control over your life. Why time is more valuable than possessions? Imagine two people. The first owns a luxury sports car, but works 80 hours every week just to maintain that lifestyle. The second drives an ordinary car, lives in a modest home, and has enough savings to work only 4 days a week. Who is richer? Most people would notice the expensive car first. But Morgan Housel would argue that the second person is wealthier. Why? Because they possess something money cannot replace once it's gone. Time. Every hour you spend doing something you hate just to support an expensive lifestyle is an hour you'll never get back. That's why financial independence isn't really about quitting work. It's about having the freedom to choose your work. The happiness research. Researchers have spent decades studying what actually makes people happy. One conclusion appears again and again. People are happiest when they feel they have control over their lives. Having autonomy, being able to decide what you do, when you do it, and with whom you do it, is consistently linked to greater life satisfaction. Money contributes to happiness, not because it buys more things. It contributes because it reduces stress and increases choice. The freedom to decide how you spend your time is often far more valuable than any object money can purchase. Beware lifestyle inflation. Here's where many people get trapped. As their income increases, so does their spending. A larger salary leads to a larger house, then a newer car, then more subscriptions, then more expensive vacations. Each purchase seems reasonable on its own, but together, they create a lifestyle that requires even more income to sustain. Soon, the person earning twice as much doesn't actually have more freedom. They're simply maintaining a more expensive version of the same treadmill. More income doesn't automatically create more freedom. Only the gap between what you earn and what you spend does. Money as a tool, not a trophy. Society often encourages us to use money as a symbol of success. We buy things to impress people. We upgrade because everyone else is upgrading. We chase status instead of satisfaction. But if every dollar goes toward maintaining appearances, very little remains to purchase the one thing that truly matters: freedom. Imagine using every raise not to increase your lifestyle, but to increase your choices. Over time, those choices compound. One day, you realize you're no longer working because you have to. You're working because you want to. That's an entirely different experience. Actionable lesson. The next time your income increases, resist the urge to immediately increase your spending. Instead, ask yourself, how can this extra money buy me more freedom? Maybe it goes into investments. Maybe it builds your emergency fund. Maybe it reduces debt. Every dollar saved a day is buying a little more control over your future. Memorable quote. The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. That doesn't mean doing nothing. It means having the freedom to choose. And according to Morgan Housel, there is no purchase more valuable than that. Chapter 8. Man in the Car Paradox. Imagine you're driving through your neighborhood when a brand new luxury sports car pulls up beside you. The paint gleams in the sunlight. The engine roars. People stop and stare. You might find yourself thinking, wow, that person must be incredibly successful. But here's Morgan Housel's surprising question. When you admire someone's expensive car, are you really admiring the car, or are you imagining yourself owning it? This is what he calls the man in the car paradox. What we think people notice. Many purchases are driven by one hidden motivation. We want admiration. We believe owning impressive things will make other people respect us. A bigger house, a luxury watch, designer clothing, an expensive car. We imagine people looking at us with envy, but reality is very different. When someone sees your luxury car, they usually aren't thinking, I wish I could be friends with that person. They're thinking, I wish I had that car. Their attention isn't focused on you. It's focused on themselves. Status is often misunderstood. This insight changes everything. People don't admire possessions nearly as much as we think. They admire qualities, kindness, confidence, wisdom, integrity, generosity. Yet we often spend enormous amounts of money trying to earn admiration through material objects. Ironically, those purchases frequently produce far less respect than we expected, because most people are busy thinking about their own lives. The invisible audience. Imagine giving a presentation. You feel certain everyone notices every small mistake. Psychologists call this the spotlight effect. In reality, most people are focused on themselves. The same principle applies to money. We imagine everyone paying close attention to what we own, but they're usually occupied with their own concerns. That expensive watch you bought to impress people, most won't notice. And those who do may simply wonder what it would feel like to own one themselves. Very few are thinking about you as much as you imagine. The cost of chasing status. The danger isn't buying nice things. There's nothing inherently wrong with enjoying the fruits of your hard work. The danger is spending beyond your means in pursuit of admiration that doesn't actually exist. Imagine financing a luxury vehicle that consumes a large portion of your income. Now you're working longer hours to make payments, experiencing more financial stress, and sacrificing your future savings, all to impress people who rarely think about your car after they've walked away. That's a very expensive illusion. Real status can't be purchased. Think about the people you genuinely admire. Is it because of the car they drive or the size of their house? Probably not. You admire them because of how they treat others, because they're knowledgeable, because they're trustworthy, because they've accomplished meaningful things. Those qualities don't require luxury purchases. In fact, many truly wealthy people live surprisingly modest lives. They understand that confidence doesn't need constant validation. Wealth is often invisible. This chapter connects beautifully with one of the book's recurring themes. The people who appear rich aren't always wealthy. And the people who are truly wealthy often don't appear rich. Someone driving an expensive car may have enormous debt. Someone driving an ordinary car may have millions invested. Appearance tells only a tiny part of the story. The wealth that creates freedom usually remains invisible. Actionable lesson. Before making a major purchase, ask yourself, am I buying this because it genuinely improves my life, or because I hope other people will admire me? That one question can save you thousands of dollars and countless hours of unnecessary work. Buy things because they bring you value, not because they create an image. Memorable quote. No one is impressed with your possessions as much as you are. It's a simple sentence. But once you truly understand it, you'll stop chasing approval through spending. Instead, you'll begin investing in the things that create lasting fulfillment. Financial security, meaningful relationships, personal growth, and freedom. Chapter 9. Wealth is what you don't see. Imagine you're walking through an upscale neighborhood. You see luxury homes with perfectly landscaped gardens. High-end cars are parked in spacious driveways. People are dressed in designer clothes, wearing expensive watches, carrying the latest smartphones. Your first thought might be, those people are wealthy. But Morgan Housel asks us to consider a completely different perspective. What if everything you're looking at is actually the opposite of wealth? That sounds strange at first. After all, expensive possessions are often associated with financial success. But Housel explains one of the most important ideas in the entire book. Wealth is what you don't see. The difference between rich and wealthy. Many people use the words rich and wealthy as if they mean the same thing. They don't. Being rich means you have a high income or spend a lot of money. Being wealthy means you've accumulated assets that continue working for you. Rich is visible. Wealth is invisible. A person earning $500,000 a year may spend nearly every dollar they make. Another person earning a modest salary may quietly invest consistently for decades. One looks rich. The other becomes wealthy. The difference isn't always income. It's what happens after the paycheck arrives. The invisible asset. Imagine two neighbors. Neighbor A buys a luxury SUV the moment they receive a promotion. Neighbor B keeps driving the same reliable car and invests the extra income. 10 years later, who is likely to have more financial freedom? Probably neighbor B. But here's the interesting part. For those 10 years, most people would have assumed neighbor A was more successful. Why? Because spending is easy to see. Saving is almost invisible. You can photograph a mansion. You can't photograph a retirement account. You can admire a designer suit. You can't admire someone's disciplined investment portfolio because it isn't on display. True wealth quietly grows behind the scenes. Every dollar has a choice. Whenever money enters your life, you have two options. You can spend it today, or you can save and invest it for tomorrow. Neither choice is automatically right or wrong. But every dollar you spend is a dollar that can no longer compound. Imagine receiving a $10,000 bonus. You could buy luxury furniture, upgrade your electronics, or take an extravagant vacation. Those purchases might bring temporary happiness. Or you could invest that same money. Years later, it may have grown significantly, creating opportunities your past self couldn't even imagine. The difference isn't visible on the day you receive the bonus. But over decades, it becomes enormous. The silent power of savings. One reason saving feels difficult is because there's no audience. No one applauds the money sitting quietly in your investment account. No one compliments your emergency fund. No one notices that you resisted buying something unnecessary. Spending receives attention. Saving rarely does. Yet it's those invisible decisions that quietly shape your future. Every investment you don't touch. Every unnecessary purchase you avoid. Every paycheck from which you save a little becomes another brick in the foundation of your financial independence. The illusion of appearance. Society often encourages us to display success. Luxury brands exist because people value status. Advertisers constantly suggest that buying more will make us appear more successful. But appearances can be deceptive. Someone driving a $150,000 sports car might still owe the bank most of its value. Someone wearing simple clothes might own millions in investments. Without seeing someone's balance sheet, you know very little about their financial reality. That's why comparing yourself to appearances is so dangerous. You're comparing your reality to someone else's spending, not necessarily their wealth. Wealth creates options. Remember what we learned in the previous chapter. Money's greatest benefit is freedom. Invisible wealth creates visible choices. It allows someone to retire earlier, take a career break, start a business, help family members, support charitable causes, weather economic downturns without panic. Those opportunities don't come from looking wealthy. They come from actually being wealthy. Actionable lesson. The next time you receive extra income, ask yourself, do I want to look wealthy today or become wealthier tomorrow? It's a simple question, but answering it honestly can completely change your financial future. Whenever possible, let your assets grow quietly in the background, because the wealth no one sees today is often the freedom everyone notices tomorrow. Memorable quote: spending money to show people how much money you have is the fastest way to have less money. It's a powerful reminder that appearances can be purchased. Real wealth must be built. Chapter 10. Save money. Imagine two people with identical salaries. One constantly says, I'll start saving once I earn more. The other saves a small percentage of every paycheck, regardless of how much they earn. Fast forward 20 years. Who is more financially secure? Most likely the second person, not because they earn more, but because they developed a habit. In this chapter, Morgan Housel delivers one of the simplest yet most overlooked lessons in personal finance. Saving isn't just about income. It's about behavior. Why most people think they can't save. Ask people why they don't save. The most common answer is, I don't make enough money. Certainly, low income can make saving genuinely difficult. But Housel points out that many high-income earners also struggle to save. Why? Because spending tends to grow alongside income. This is known as lifestyle inflation. Every raise becomes an excuse for a bigger house, a newer car, more expensive vacations, fancier restaurants. Soon, the additional income disappears. Not because they needed more, because they gradually became accustomed to spending more. Saving creates flexibility. Think of savings as a financial shock absorber. Life is unpredictable. Jobs disappear. Businesses struggle. Unexpected medical expenses arise. Economic recessions happen. Without savings, even small emergencies become financial crises. With savings, the same events become manageable challenges instead of disasters. Savings don't eliminate uncertainty. They reduce the damage uncertainty can cause. Saving isn't about deprivation. Many people view saving as punishment. They imagine giving up everything they enjoy. Morgan Housel offers a healthier perspective. Saving isn't about saying no to life. It's about giving your future self more choices. Imagine setting aside part of your income every month. At first, the amount may seem small, but over time, those savings become opportunities. The opportunity to change careers, the opportunity to relocate, the opportunity to start a business, the opportunity to retire comfortably. Every dollar saved increases your future flexibility. The importance of room to breathe. Imagine living paycheck to paycheck. Every unexpected expense feels like a crisis. Now imagine having 6 months of living expenses saved. The same problem still exists, but your emotional response changes completely. Instead of panic, you have options. That emotional benefit is one of the greatest returns savings provide. Money isn't valuable only because of what it buys. It's valuable because of the stress it prevents. Saving without a specific goal. One of Housel's most refreshing ideas is that you don't always need a detailed reason to save. Many financial experts encourage saving for specific goals. A house, retirement, college, vacation. Those are excellent reasons. But life often surprises us in ways we can't predict. Saving simply because the future is uncertain is reason enough. You don't know exactly what opportunities or problems will appear, but when they do, you'll be prepared. Wealth loves humility. People often feel pressure to spend every dollar they earn, to keep up with friends, to reward themselves, to demonstrate success. Saving requires humility. It means resisting short-term applause in exchange for long-term security. No one congratulates you for contributing to your investment account, but your future self certainly will. Actionable lesson. Start treating saving as a permanent habit rather than a temporary goal. Instead of asking, how much can I save after I spend? Reverse the question, how much will I save before I spend? Automate it if possible. Even small amounts saved consistently become meaningful through time and compounding. Remember, you don't need to save what's left after your expenses. You need to build your expenses around your savings. Memorable quote, "The value of wealth is relative to what you need." And one of the fastest ways to build wealth isn't always increasing your income. It's consistently keeping part of what you already earn. Chapter 11, Reasonable, Rational. Imagine you're sitting with a financial advisor. They show you a chart proving that investing every available dollar into stocks will likely maximize your long-term returns. Mathematically, it makes perfect sense. But then they tell you that along the way, your investments could lose 40%, 50%, or even 60% of their value during market crashes. Would you still invest every penny? Many people wouldn't. Not because the math is wrong, because they're human. And that is the heart of Morgan Housel's 11th lesson. When it comes to money, being reasonable is often far more important than being perfectly rational. The difference between rational and reasonable. At first, these words seem interchangeable, but they're not. A rational decision is one that is mathematically optimal. A reasonable decision is one you can actually live with. Here's an example. Suppose financial research proves that investing 100% of your savings in stocks will generate the highest expected return over the next 30 years. That may be rational. But imagine watching half your life savings disappear during a market crash. If that fear causes you to panic and sell everything at the bottom, then the perfect strategy has failed. Why? Because it ignored human behavior. The best financial plan isn't the one with the highest theoretical return. It's the one you can stick with through both good times and bad. Emotions are part of investing. Many people believe successful investors never let emotions influence their decisions. The truth is exactly the opposite. Successful investors understand their emotions. They build strategies that work with their personalities instead of against them. Imagine two investors. The first constantly chases the highest possible returns. The second chooses a slightly more conservative portfolio that helps him sleep peacefully at night. 30 years later, who is more likely to succeed? Often, it's the second investor, because consistency usually beats perfection. The cost of stress. Financial decisions don't happen in a laboratory. They happen in real life. Real people experience anxiety. They worry about losing jobs. They care for families. They face unexpected emergencies. If your financial strategy causes constant stress, you're less likely to maintain it. Imagine earning 1 or 2% less each year, but avoiding years of panic, sleepless nights, and emotional decisions. That trade-off might actually produce better long-term results. Peace of mind has value, even if it can't be measured on a spreadsheet. Personal finance is personal. One reason financial advice often conflicts is because different people value different things. A young entrepreneur might happily accept enormous financial risks. A retired couple may prioritize stability above everything else. Neither approach is universally correct. The right strategy depends on your personality, responsibilities, and goals. Try to copy someone else's financial plan without considering your own emotional comfort is like wearing shoes that don't fit. They may be excellent shoes. They're just not designed for you. Avoid strategies you can't sustain. Think about dieting. The perfect diet might promise rapid weight loss, but if it's impossible to maintain, the results won't last. Investing is similar. The perfect investment strategy on paper is worthless if you abandon it during difficult times. Morgan Housel encourages readers to choose approaches they can follow consistently, even if those approaches aren't mathematically perfect. Because success comes from staying invested, not from constantly searching for perfection. Actionable lesson. Ask yourself an important question. Can I still follow this financial plan during my worst emotional moments? If the answer is no, simplify it. Reduce risk if necessary. Build a strategy that allows you to remain calm when markets become turbulent. Your goal isn't to impress economists. Your goal is to build lasting wealth. Memorable quote. Reasonable people make reasonable decisions. Rational people make mathematically perfect ones. Real financial success usually belongs to the reasonable. That lesson reminds us that money isn't managed by calculators. It's managed by people. And people need strategies they can actually live with. Chapter 12. Surprise? Imagine you're certain you figured everything out. You've studied the markets, read dozens of books, built the perfect investment plan. You're convinced you prepared for every possibility. Then, a global pandemic shuts down the world, or a financial crisis causes markets to collapse, or a revolutionary technology changes entire industries overnight. Suddenly, everything you expected becomes irrelevant. Morgan Housel's message is clear. The future will always surprise us. And that's why humility is one of the greatest financial strengths. History is full of surprises. Think about the biggest events that shaped the world. The Great Depression, the rise of the internet, the 2008 financial crisis, the COVID-19 pandemic. Very few people predicted these events with accuracy before they happened. Yet after they occur, People often convince themselves the warning signs were obvious. This is called hindsight bias. Once we know the outcome, it feels predictable. But before it happened, it wasn't. That's why relying too heavily on forecasts can be dangerous. The limits of prediction. Humans love certainty. We want experts to tell us exactly what markets will do next year, exactly where housing prices are heading, exactly when the next recession will begin. The reality is much less satisfying. Nobody knows with certainty. Even experienced economists and investors regularly fail to predict major turning points. The future contains too many unknown variables. Trying to forecast everything often creates false confidence instead of genuine preparedness. The danger of overconfidence. Imagine someone who has correctly predicted several market trends. After a few successful forecasts, they begin believing they can predict everything. Then comes an unexpected event. Markets move in ways they never anticipated. Years of confidence disappear almost overnight. Success can trick us into believing uncertainty has disappeared. It hasn't. It's simply waiting for the next surprise. Build for uncertainty. If surprises are inevitable, how should we prepare? Morgan Housel's answer is surprisingly simple. Don't build your financial life around perfect predictions. Build it around resilience. Imagine constructing a bridge. Would you design it to hold exactly the expected weight? Of course not. You'd build extra strength into the structure because unexpected situations will occur. Financial planning deserves the same mindset. Maintain emergency savings. Avoid excessive debt. Diversify your investments. Leave room for mistakes. These habits don't predict surprises. They prepare you to survive them. Flexibility beats certainty. Many people spend enormous energy trying to forecast the future. Far fewer spend time making themselves adaptable. Imagine two businesses. One depends entirely on a single customer. The other has many customers across different industries. Which one is better prepared for unexpected change? The second. The same principle applies to personal finances. The more flexible your financial life becomes, the less damage unexpected events can cause. Accept that you won't know everything. This chapter isn't encouraging pessimism. It's encouraging humility. Recognizing uncertainty doesn't weaken your confidence. It strengthens your decision-making. Because instead of assuming you're always right, you prepare for the possibility that you might be wrong. That's a much safer way to approach investing and life. Actionable lesson. The next time someone confidently predicts the future of the economy, ask yourself, what if they're wrong? Not because they lack intelligence, but because uncertainty is unavoidable. Instead of betting everything on one prediction, build a financial life that can survive many different outcomes. Memorable quote. The most important economic events of the future will probably be things nobody is talking about today. That single idea reminds us why humility matters. The future belongs to those who are prepared, not those who believe they predicted every possibility. Chapter 13, Room for Error. Imagine you're about to board an airplane. As passengers settle into their seats, the pilot steps onto the intercom and says, "Ladies and gentlemen, we've calculated the exact amount of fuel needed for this flight. There isn't a single extra gallon on board because we don't expect any delays, weather changes, or emergencies." Would you feel comfortable? Probably not. Even if the calculations were correct, you'd know that real life rarely goes exactly as planned. Unexpected things happen. Flights get rerouted. Weather changes. Emergencies occur. That's why airplanes always carry extra fuel. Not because the pilots expect disaster, but because they respect uncertainty. Morgan Housel says your financial life should work exactly the same way. Always leave room for error. The danger of living on the edge. Many people build their financial lives with no margin for mistakes. They borrow the maximum amount the bank will lend. They spend every paycheck. They invest money they'll soon need. Everything works perfectly, as long as life goes exactly according to plan. But life almost never does. A job is lost. A business slows down. Unexpected medical bills arrive. Markets decline. Suddenly, a plan that looked brilliant collapses because it had no room for unexpected events. The problem wasn't bad intentions. It was the absence of a safety margin. Why optimism needs protection. Morgan Housel believes optimism is important. Optimistic people build businesses, invest, innovate, take opportunities. But optimism without preparation becomes dangerous. Imagine climbing a mountain. You expect good weather, but you still pack extra food, warm clothing, and emergency supplies. Why? Because optimism doesn't eliminate uncertainty. Preparation makes optimism sustainable. Financial planning works the same way. Hope for the best. Prepare for something less than perfect. The story of nature. Look at nature for a moment. Trees produce thousands of seeds. Most never become trees. Animals store extra food before winter. The human body contains 2 kidneys, even though one can perform the necessary function. Nature constantly builds redundancy. Why? Because survival depends on preparing for uncertainty. Successful financial lives often follow the same principle. The strongest people aren't those who assume everything will go perfectly. They're those who prepare for the possibility that it won't. Cash isn't lazy. Many people criticize holding cash. They argue that cash earns less than investments. Mathematically, they're often correct. But Morgan Housel asks us to think differently. Cash isn't only about returns. It's about flexibility. Imagine the stock market falls by 40%. One investor has no savings. They're forced to sell investments to pay bills. Another investor has emergency cash. They can continue investing or even buy assets at lower prices. Who has the advantage? The second investor. Not because cash earned the highest return, but because cash created options. Sometimes the value of money isn't what it earns. It's what it allows you to avoid. Margin creates confidence. Think about walking across a narrow bridge. Now imagine that bridge is only 1 foot wide. Even if it's perfectly safe, you'll probably walk cautiously. Now imagine another bridge that's 20 feet wide. You'll walk much more confidently. Why? Because there's room for mistakes. Financial margins work exactly the same way. Savings create emotional confidence. Low debt creates flexibility. Conservative planning creates peace of mind. You don't need perfection. You need space. The cost of ignoring uncertainty. History repeatedly teaches this lesson. Businesses that borrowed too aggressively often collapsed during recessions. Families living paycheck to paycheck struggled when unexpected expenses appeared. Investors using excessive leverage lost fortunes during market crashes. None of them planned to fail. They simply assumed life would continue as expected. The people who survived weren't necessarily smarter. They simply left room for error. Actionable lesson. Ask yourself, if something unexpected happened tomorrow, how prepared would I be? Could you survive 6 months without income? Do you have emergency savings? Would one unexpected expense create financial panic? If the answer worries you, begin building your margin today. Even small improvements create enormous long-term security. Memorable quote, the most important part of every financial plan is planning for the plan not going according to plan. That may sound simple, but it separates those who merely hope from those who truly prepare. Chapter 14, You'll Change. Imagine meeting your younger self from 10 years ago. What advice would you give? Perhaps you'd laugh at the clothes you wore, the career you wanted, the people you admired, the goals you thought mattered. Now, ask yourself another question. How confident are you that the person you'll become 10 years from now will think exactly like you do today? Probably not very. Morgan Housel's 14th lesson is both simple and profound. People change. And because we change, our financial decisions should leave room for that reality. The illusion of permanence. Psychologists have discovered something fascinating. People readily admit they've changed in the past, but they consistently underestimate how much they'll change in the future. This is known as the end of history illusion. We believe we've finally become the person we'll always be. But life has other plans. Your priorities evolve. Your interests shift. Your relationships change. Your definition of success matures. The person you become at 50 may have very different dreams than the person you are at 25. The financial consequences. Imagine someone taking on enormous debt to buy their dream house. They confidently believe they'll love living there forever. 5 years later, a new career opportunity appears in another city. Their family grows. Their priorities change. Now that dream house has become a financial burden. The problem wasn't poor judgment. The problem was assuming today's desires would never change. Money decisions often last much longer than our current preferences. That's why flexibility matters. Avoid locking yourself into one future. Think about signing a contract that determines the next 30 years of your life. Wouldn't you hesitate? Yet people often make financial commitments that effectively do exactly that. Massive mortgages, excessive debt, lifestyle expenses that require permanently high incomes, long-term obligations based on who they are today. But tomorrow's version of yourself may want something completely different. Leaving room for change isn't indecision. It's wisdom. Wealth creates the freedom to evolve. Remember Chapter 7? Freedom is money's greatest benefit. This chapter builds on that idea. Financial flexibility doesn't just protect you from emergencies. It protects you from becoming trapped by your own past decisions. Imagine realizing at 40 that you'd rather become a teacher than continue in a high-paying corporate job. If you built savings, reduced debt, and lived below your means, that transition becomes possible. Without financial flexibility, many people remain in careers they no longer enjoy simply because they can't afford a change. Money gives you the ability to reinvent yourself. Don't judge your future self too quickly. Many people delay saving because they assume their future selves will simply earn more. Others overspend because they assume they'll always value the same lifestyle. Both assumptions can be dangerous. Your future income isn't guaranteed. Neither are your future desires. The safest approach is to build options rather than commitments. Options allow future versions of yourself to make different choices. Commitments often remove those choices. Invest in flexibility. Imagine having enough savings to move cities, change careers, start a business, take time off to care for a family member, return to school, travel. Those opportunities aren't possible because someone predicted the future perfectly. They're possible because they prepared for a future they couldn't predict. That's the true purpose of financial flexibility. Actionable lesson. Before making any major financial commitment, ask yourself, if my priorities change 5 years from now, would this decision still give me options? If the answer is no, think carefully. The future version of you deserves flexibility too. Memorable quote. Long-term planning is harder than it seems because people's goals and desires change over time. That's why the smartest financial plans aren't built around certainty. They're built around adaptability. Chapter 15. Nothing's free. Imagine someone walks up to you and says, I have an investment that guarantees incredible returns with absolutely no risk, no stress, and no downside. Would you believe them? Probably not. Because deep down, we all understand one simple truth. Nothing valuable in life comes completely free. Yet, when it comes to money, people often forget this principle. They chase investments promising huge returns without volatility. They expect wealth without sacrifice. They want extraordinary rewards without paying any emotional price. Morgan Housel's 15th lesson reminds us of a reality that every successful investor eventually learns. Every reward has a cost. The question isn't whether you'll pay. The question is what kind of price you're willing to pay. Every investment has a price tag. When people think about investing, they usually focus on money. How much will I earn? What's the return? How fast will my investment grow? But Housel says there's another kind of price, one that's often much harder to see. It's the emotional cost. Imagine investing in the stock market. 1 year your portfolio rises 20%. You feel brilliant. The next year it falls 35%. Suddenly you're questioning every decision you've ever made. The market isn't broken. It's simply asking you to pay the price for long-term returns. That price is uncertainty. Volatility isn't a fine, it's the admission ticket. Many investors treat market declines as if something has gone terribly wrong. Morgan Housel argues that volatility isn't a punishment. It's the fee you pay for earning higher long-term returns. Think about going to a world-famous amusement park. You don't complain that there's an admission fee. You understand that the experience is worth the cost. Investing works the same way. Temporary declines are the admission fee for long-term wealth. People who refuse to pay that fee often leave the market too early. And by avoiding short-term discomfort, they also avoid long-term rewards. The cost of success. This lesson applies far beyond investing. Every worthwhile achievement has its own price. A successful business requires years of uncertainty. A healthy body requires consistent discipline. Strong relationships require patience and forgiveness. Financial independence requires saving instead of spending. We admire successful people, but we often overlook the invisible price they paid to get there. Late nights, sacrifices, failures, years of persistence. Success isn't free. It's simply that the price is usually paid before the reward arrives. Don't mistake the fee for failure. Imagine paying for a gym membership. After 1 month, your muscles feel sore. Would you conclude the gym isn't working? Of course not. The soreness is evidence that your body is adapting. Market volatility works similarly. When investments fluctuate, many people assume something has gone wrong. Sometimes that's true, but often volatility is simply part of the process. Confusing temporary discomfort with permanent failure leads many investors to abandon excellent strategies. Patience is expensive. Perhaps the hardest price to pay is patience. Our culture celebrates speed, fast internet, instant deliveries, overnight success. But wealth rarely grows that way. Compounding demands time. Long-term investing demands waiting. Building financial freedom requires years of consistent behavior. The waiting itself becomes part of the cost. Those who accept it are often rewarded. Those who reject it keep searching for shortcuts that rarely exist. Choosing your price. Here's the encouraging part. You get to choose which price you're willing to pay. You can pay the price of discipline today, or the price of financial stress tomorrow. You can pay the price of saving, or the price of regret later. You can accept market volatility, or accept lower long-term returns. Every path has a cost. Wisdom lies in choosing the cost you can live with. Actionable lesson. The next time an investment becomes uncomfortable, don't immediately ask, is something wrong? Instead ask, is this simply the normal price of achieving my long-term goal? That simple shift in thinking can prevent many costly emotional decisions. Memorable quote, market volatility is the price of admission. The prize inside is superior long-term returns. Once you stop viewing volatility as punishment, it becomes much easier to remain patient when others panic. Chapter 16, You and Me. Imagine two investors sitting side by side. They're reading the same financial news, looking at the same stock market, watching the same economic reports. Yet one decides to buy, the other decides to sell. How can two intelligent people reach opposite conclusions using the same information? Morgan Housel's answer is surprisingly simple, because they're playing different games. And one of the biggest mistakes in personal finance is assuming everyone is playing the same game you are. Different goals, different decisions. Imagine a day trader. Their goal is to profit from price movements over the next few hours. Now imagine someone saving for retirement 30 years from now. Should they make the same investment decisions? Of course not. The trader and the long-term investor are operating under completely different timelines. Yet people constantly compare themselves to others without realizing they're pursuing different objectives. A decision that makes perfect sense for one person may be completely inappropriate for another. Why financial news creates confusion. Turn on a financial news channel. One expert predicts stocks will rise. Another warns of an impending crash. A third recommends buying commodities. A fourth suggests holding cash. Who should you believe? Perhaps all of them, or none of them. Each expert may be speaking to a different audience with different goals. The problem begins when we assume their advice automatically applies to us. Stop copying other people's strategies. Imagine watching a professional race car driver take a sharp corner at incredible speed. Would you immediately try to copy them on your drive home? Probably not. You understand they're operating under different conditions. Financial markets deserve the same respect. Someone managing billions of dollars isn't necessarily making decisions that suit someone saving for retirement. An entrepreneur may tolerate risks that would be reckless for a family living paycheck to paycheck. The strategy isn't universally right or wrong. It's appropriate or inappropriate for a specific situation. Time changes everything. One of the biggest differences between investors is time horizon. Someone needing money next month must think differently from someone investing for the next 40 years. During market declines, short-term investors often panic. Long-term investors may actually see opportunity. The same event produces opposite reactions because they're solving different problems. Understanding your own timeline protects you from making decisions based on someone else's priorities. Beware comparison. This chapter also connects to one of the book's recurring themes. Comparison creates confusion. You see someone making huge profits trading cryptocurrencies, another buying real estate, another investing in startups. You begin wondering whether you're falling behind. But unless you understand their goals, experience, risk tolerance, and financial responsibilities, comparing yourself is meaningless. You may be judging your progress using someone else's scoreboard. Define your own game. Financial success isn't about winning every competition. It's about achieving your own goals. Imagine two runners. One is sprinting 100 meters. The other is running a marathon. If the marathon runner tries to match the sprinter's speed, they'll collapse long before reaching the finish line. Money works exactly the same way. Know your race. Run your pace. Ignore distractions. Actionable lesson. Before following financial advice, ask yourself, is this advice meant for someone in my situation? Consider your age, income, family responsibilities, risk tolerance, time horizon, personal goals. The best financial plan is the one designed for your life, not someone else's. Memorable quote: few things matter more with money than understanding your own time horizon and not being persuaded by people playing a different game. Once you understand that everyone is solving different financial problems, you'll stop chasing strategies that don't fit your own journey. Chapter 17. The Seduction of Pessimism. Imagine turning on the evening news. One headline warns of an economic collapse. Another predicts a housing market crash. A third claims artificial intelligence will eliminate millions of jobs. Then you open social media. People are saying the economy is doomed. The stock market is a bubble. The next recession is just around the corner. After hearing these messages over and over, it's easy to believe the future looks hopeless. Morgan Housel calls this the seduction of pessimism, and he argues that our brains are naturally drawn to bad news, even when history gives us plenty of reasons to be optimistic. Why bad news gets more attention. Imagine two newspaper headlines. The first says, "Global economy continues to grow steadily." The second says, "Markets plunge. Experts fear financial disaster." Which headline are you more likely to click? Most people choose the second, not because they enjoy negativity, because the human brain evolved to pay attention to danger. Thousands of years ago, ignoring potential threats could cost you your life. Today, that same instinct causes us to focus on financial disasters far more than slow, steady progress. Our survival instincts haven't changed. The world has. Progress is quiet. Here's something interesting. Most positive change happens gradually. Technology improves little by little. Businesses slowly become more productive. Medical breakthroughs develop over decades. The economy generally grows through millions of small improvements happening every day. None of that makes dramatic headlines. Disasters, however, happen suddenly. A market crashes. A bank fails. A company goes bankrupt. These events dominate the news because they're immediate, emotional, and unexpected. As a result, we often believe the world is getting worse, even when long-term progress continues. The difference between headlines and history. Think back over the last century. The world has experienced world wars, financial crises, pandemics, political instability, inflation, technological disruption. Despite all of these challenges, living standards have improved dramatically over time. Businesses have continued to innovate. Markets have recovered. Entire industries have emerged that didn't exist a generation ago. This doesn't mean setbacks aren't real. They absolutely are. But history reminds us that human progress has an extraordinary ability to continue despite enormous obstacles. Why investors panic. Imagine investing during a severe market decline. News outlets predict further losses. Friends are selling their investments. Fear spreads everywhere. At that moment, pessimism feels intelligent. Optimism feels reckless. Yet history repeatedly shows that some of the greatest investment opportunities have appeared during periods of maximum fear. The challenge is emotional. It's incredibly difficult to remain optimistic when everyone around you is convinced things will only get worse. That's why successful investing often requires trusting long-term history rather than short-term headlines. Optimism isn't blind confidence. Morgan Housel makes an important distinction. Optimism doesn't mean believing everything will always go perfectly. It means believing that despite setbacks, humanity has an incredible ability to adapt, solve problems, and move forward. Optimists recognize recessions. They acknowledge crises. They prepare for uncertainty. But they also believe today's problems won't define tomorrow forever. That's a much healthier perspective than assuming every setback marks the end of progress. Protect your mind. Imagine spending every day consuming negative financial news. Eventually, you may become convinced that investing is pointless, that saving won't matter, that disaster is inevitable. The danger isn't simply emotional. It affects your behavior. Fear can cause people to stop investing, delay important financial decisions, or abandon long-term plans because of short-term anxiety. Protecting your financial future also means protecting your mindset. Actionable lesson. The next time you hear a frightening financial prediction, pause and ask yourself, is this describing a temporary event or the entire future? Then remember history. Human progress has survived wars, depressions, pandemics, and countless crises. The future will almost certainly contain new challenges, but it will also contain new opportunities. Memorable quote. Optimism sounds like a sales pitch. Pessimism sounds like someone trying to help you. That's why bad news feels so convincing. But convincing isn't always correct. Sometimes the wisest financial decision is quietly believing in the long-term resilience of people, businesses, and economies. Chapter 18. When you'll believe anything. Imagine you're scrolling through social media. One post claims real estate is the only safe investment. Another insists cryptocurrency will make everyone rich. A third warns that the entire financial system is about to collapse. Each post sounds confident. Each includes charts, statistics, and passionate arguments. Who should you believe? Morgan Housel's answer is surprising. Be careful, because when people desperately want an explanation, they'll often believe almost anything. We crave certainty. Humans dislike uncertainty. When confusing events happen, we naturally search for explanations. Imagine the stock market suddenly falls 15%. People immediately ask, why? Experts rush to provide answers. News headlines confidently explain the cause. But here's the truth. Financial markets are influenced by millions of investors, countless decisions, and unpredictable global events. No single explanation can fully capture such complexity. Yet simple stories are emotionally satisfying. Even when they're incomplete, stories are more powerful than facts. Imagine two financial advisors. The first presents complex data with uncertainty. The second tells a compelling story with absolute confidence. Who will most people believe? Usually the storyteller. Our brains are wired for narratives. Stories help us organize complicated information. The problem arises when the story becomes more persuasive than evidence. That's how financial myths spread. People don't always believe what's most accurate. They often believe what's easiest to understand. Beware of absolute confidence. One warning sign should immediately capture your attention. Someone who claims they know exactly what's going to happen. The future is uncertain. Markets are uncertain. Economies are uncertain. Anyone speaking with complete certainty about unpredictable events deserves healthy skepticism. Real expertise often sounds humble. Experts acknowledge uncertainty. They discuss probabilities rather than guarantees. They admit when they don't know. Ironically, people with the most confidence aren't always the most knowledgeable. The danger of confirmation bias. Imagine you already believe housing prices will crash. Without realizing it, you'll begin noticing every article supporting that belief. Articles suggesting the opposite become easy to ignore. This is called confirmation bias. We naturally search for information that agrees with what we already think. The result? Our opinions become stronger, even if the evidence remains mixed. Financial success requires challenging your own assumptions instead of constantly reinforcing them. Simplicity can be misleading. People love simple financial formulas. This investment always wins. That asset is guaranteed. This strategy never fails. Reality is rarely so simple. Every investment carries risk. Every strategy has weaknesses. Every economy changes over time. The people who recognize complexity are often better prepared than those chasing easy answers. Think like a scientist. Scientists don't begin by trying to prove themselves right. They actively test whether they might be wrong. Imagine applying that mindset to your financial decisions. Instead of asking, "Why am I right?" ask, "What evidence would prove me wrong?" That single habit can protect you from countless expensive mistakes. Stay curious. One of the greatest financial advantages isn't intelligence. It's curiosity. Curious people continue learning. They change their minds when evidence changes. They don't become emotionally attached to one prediction or one investment philosophy. That flexibility allows them to adapt as the world evolves. Actionable lesson. The next time someone confidently predicts the future, remember 3 questions. What evidence supports this? What evidence challenges it? What if the opposite turns out to be true? Those questions encourage thoughtful decisions instead of emotional reactions. Memorable quote. The more you want something to be true, the more likely you are to believe a story that overestimates the chances of it being true. That's why critical thinking is such a valuable financial skill. Money rewards those who remain open-minded, skeptical of certainty, and willing to learn continuously. Chapter 19, All Together Now. We've reached the final lesson of the psychology of money. By now, we've explored 19 different ideas. Some focus on saving, others on investing. Some explain the dangers of greed. Others emphasize patience, humility, and freedom. At first, these lessons may seem unrelated, but Morgan Housel now brings them all together into one simple philosophy. He asks an important question. If you had to summarize everything we've learned into a practical approach to building wealth, what would it look like? This chapter is his answer. Wealth is built through behavior. Think back to the beginning of the book. We learned that no one is completely rational with money. Our experiences shape our decisions. Luck and risk influence outcomes. Greed can destroy fortunes. Patience creates extraordinary results. Notice something? Very little of this has anything to do with complex financial formulas. That's because financial success is primarily behavioral. Knowing what to do isn't enough. You have to keep doing it. Again, and again, and again. Save consistently. One of the book's biggest themes is saving. Not because saving alone makes you wealthy, but because saving creates options. It prepares you for uncertainty. It allows you to invest. It gives you freedom. Every dollar you don't spend today becomes a resource for tomorrow. Saving isn't simply a financial habit. It's an investment in flexibility. Respect compounding. Imagine planting a tree. You water it regularly. Protect it from storms. Wait patiently. Years pass before it provides meaningful shade. Money behaves similarly. Small actions repeated consistently create remarkable outcomes over time. Most people underestimate what decades of disciplined investing can accomplish. Not because compounding is weak, because it requires patience. Stay humble. One of the most dangerous moments in finance isn't failure. It's success. Success can convince us that we're invincible, that every profitable investment proves our intelligence. That risk no longer applies to us. History repeatedly shows otherwise. Markets remain unpredictable. Life remains uncertain. Humility protects us from believing our own success stories too completely. Avoid catastrophic mistakes. Building wealth doesn't require perfect decisions. It requires avoiding irreversible ones. Imagine climbing a mountain. You don't have to choose the fastest route. You simply have to avoid stepping off a cliff. Financial life works the same way. Avoid excessive debt. Don't gamble everything on one investment. Leave room for error. Protect what you've built. Survival allows compounding to continue working. Focus on freedom. Remember Chapter 7. Money's greatest purpose isn't status. It isn't luxury. It isn't impressing strangers. It's freedom, the ability to decide how you spend your time. the ability to choose meaningful work, the ability to help others, the ability to sleep peacefully at night. Every financial decision should move you closer to that freedom, not further away. Play your own game. Don't compare your journey to someone else's. Someone making risky investments today may have goals completely different from yours. Someone buying luxury possessions may be pursuing status instead of security. Measure your progress against your own values, not someone else's lifestyle. Build a financial philosophy. Morgan Housel isn't asking readers to memorize investment formulas. He's encouraging them to develop a personal philosophy, one built on patience, humility, saving, long-term thinking, flexibility, gratitude, reasonable expectations. These principles won't eliminate uncertainty, but they'll help you navigate it. Actionable lesson. Write down your own financial philosophy. It doesn't need to be complicated. Perhaps something like this: I will spend less than I earn. I will invest consistently. I will avoid unnecessary debt. I will prepare for uncertainty. I will value freedom more than appearances. And I will remain patient even when progress seems slow. Simple philosophies often outperform complicated strategies because simple philosophies are easier to follow. Memorable quote: financial success is not a hard science. It's a soft skill where how you behave is more important than what you know. That sentence may be the single most important lesson in the entire book. Knowledge matters, but behavior determines results. Chapter 20, Confessions. In the final chapter, Morgan Housel does something refreshing. Instead of presenting himself as someone who has mastered money, he simply shares his own beliefs, not as universal truths, but as personal principles that guide his financial life. This chapter feels less like a lecture and more like a conversation. There is no perfect financial plan. Morgan Housel openly admits that his financial decisions aren't always mathematically optimal. Sometimes he chooses simplicity over maximum returns. Sometimes he values peace of mind more than squeezing out another percentage point of profit. Why? Because money exists to improve life, not complicate it. The best financial plan isn't always the most sophisticated. It's the one that allows you to sleep well at night. Independence matters more than impressing others. Throughout the book, one theme appears repeatedly: freedom. Housel explains that the greatest luxury money provides is independence, the ability to control your own schedule, choose meaningful work, spend time with loved ones, avoid being trapped by financial pressure. Notice how different that is from society's definition of success. Many people chase expensive lifestyles. Housel chases flexibility, and that's an important distinction. Simplicity is powerful. Imagine managing dozens of complicated investments, constantly checking prices, reading market predictions, worrying every day. Now imagine a simple portfolio you understand completely, one that allows you to focus on your family, health, career, and passions. Which life sounds richer? Complexity often creates the illusion of intelligence. Simplicity often creates better long-term behavior. Accept that you'll never know everything. One of Housel's greatest strengths is intellectual humility. He openly acknowledges that the future is uncertain. He doesn't pretend to predict markets. He doesn't claim to know exactly what will happen next year. Instead, he prepares for uncertainty. That's a much more sustainable approach. Because confidence without certainty is wisdom. Confidence with certainty often becomes arrogance. Wealth is a means, not an end. Perhaps the most beautiful message of the entire book appears here. Money isn't the goal. Life is. Money simply makes certain parts of life easier. It reduces stress, creates choices, provides security, supports the people you love. If building wealth costs your relationships, your health, or your peace of mind, you've misunderstood its purpose. Money should serve your life, not replace it. The real measure of success. At the end of the day, financial success isn't measured by your bank account alone. It's measured by questions like these. Can you sleep peacefully? Do you have control over your time? Can you help people you care about? Are your financial decisions aligned with your values? Do you feel content with enough? Those answers matter more than any investment return. Actionable lesson. Create your own personal money rules, not rules based on trends. not rules copied from wealthy influencers. Rules that fit your life. For example, always save first. Never invest money you can't leave untouched. Avoid debt for unnecessary purchases. Prioritize freedom over status. Never risk everything for a little more. Simple principles make difficult decisions much easier. Memorable quote: "Doing well with money has little to do with how smart you are and a lot to do with how you behave." It's a fitting conclusion, because after 20 chapters, that's the lesson everything points toward. Final conclusion: the 20 timeless lessons that will change how you think about wealth. We've reached the end of the psychology of money, but hopefully this is the beginning of a new way of thinking about wealth. If there's one message that echoes throughout every chapter, it's this: money is less about mathematics and more about human behavior. You don't need to predict the market perfectly. You don't need to find the next $1 million investment. You don't need to outperform everyone else. Instead, lasting wealth is built through habits that almost anyone can develop. Be patient. Save consistently. Let compounding work its quiet magic. Stay humble when life goes well. Prepare for uncertainty before it arrives. Avoid comparing your journey to someone else's. Know what enough means for you. And remember that the greatest purpose of money isn't to make you look successful. It's to make you free. The richest person isn't necessarily the one with the biggest house or the most expensive car. The richest person is often the one who has the freedom to spend their time the way they choose, the wisdom to avoid unnecessary risks, and the peace of mind that comes from knowing they have enough. As Morgan Housel reminds us throughout this remarkable book, financial success is not a matter of luck alone, intelligence alone, or income alone. It's the result of consistent, thoughtful behavior repeated over a lifetime. If these lessons inspired you, don't just remember them, practice them. One small decision today, repeated consistently over the years, can completely transform your financial future. Thank you for joining me on this complete summary of the psychology of money. If you found value in these timeless lessons, consider sharing them with someone who could benefit from a healthier relationship with money. Sometimes the greatest investment you can make isn't in the market, it's in the way you think.